Good afternoon and welcome to this week's Halftime Talk. We're delighted to be joined by Mr. Chris Bake, a member of the Executive Committee of Vitol. Chris, welcome.
Thank you very much. Here from a snowy London, a snowy and cold London, I should say.
Well, hopefully it's really cold and icy and you have to use lots of energy to stay warm and hopefully keep that oil price propped up as it now blasts through $60 a barrel. But ultimately, the big question of the year, Chris, that everybody's trying to read their tea leaves on, how tangible is demand recovery? We're a month and a half into a year in which the forecast is close to 6 million barrel a day recovery on demand, and we haven't really seen that start yet. What's your outlook for demand recovery in 2021?
No, I think firstly, let me say good morning, everyone. After our brief introduction, but I think we have seen good recovery, Sean. I think the indications are that the crude draws end of second half of last year and well into this year, we're now in week 6, continue. Our prognosis is at least 500 million barrels draw by mid-year, by June, and a further draw beyond that. I think, yes, we have had a fairly strong recovery from the lows of 2020, as would be anticipated. As we move into second, third wave, and potentially beyond, it seems like the total economy has become a lot more resilient. Transportation demand has recovered, albeit jet. Let's not exaggerate on the jet side, because obviously there's still a lot of issues there, but for the most part, transportation demand is very strong and light end demand is strong, and overall commodity cycles, commodity prices are also very strong. If anything, oil is a little bit of the laggard there. So,
but if you take that point, I mean, again, demand recovery last year clearly solid. I mean, we talked about 20 million drop in April. We got back to an average on the year of, just shy of 10 million barrel a day demand collapse last year. This year, we're expecting a 6 million barrel a day recovery as declared by the IEA, OPEC, and so forth, a little less than 6. Half of that is jet fuel. When and where is that going to come?
The jet fuel demand?
Yeah.
I think that's obviously going to be more tempered, and that 2 to 3 million barrel a day gap between 2019 levels and projections for this year will be mostly composed of jet fuel, in our opinion, because short haul flights may resume, but long haul flights are still going to be challenged. So you will see a distillate and the distillate pool, you'll see a jet fuel deficit in demand. But for the other ends of the barrel, the other sides of the barrel, fuel, light ends, especially the naphtha, the LPGs, we continue to see very strong recovery.
We've broken through $60 inevitably for all of these reasons. The inventory draw is, as you say, very tangible. We're now getting closer and closer to the 5-year average, which is the OPEC plus target. And the forecast by OPEC itself is that they'll get there in the second quarter. Is this run up on the oil price sustainable, Chris, when you have what is about 10 million barrels a day of idle supply, closed in from OPEC plus countries, Iran, Libya, there's Venezuela on the outliers, but a lot of oil closed in, and yet the price is soaring on a tightness. How does those two things coexist?
Well, soaring being a relative term, I mean, I think we're back to January
5% or $5 last week.
Yeah, fair, but we're back to January 2020 levels. So I think it's been a recovery rather than a soaring, and that recovery has been certainly helped, especially with the demand destruction from COVID, has been held by a lot of discipline from OPEC plus, but they have maintained that discipline, and by our balances going forward into the second half of the year, OPEC Plus will have to release incremental barrels. Yes, Iran is an issue. It continues to be restricted under the embargo, but conversely, the demand recovery that we're foreseeing, that 6 million barrels plus through the balance of this year, will require not only OPEC plus, but other oil to come to market. And again, we note the fairly substantial draws in oil stocks from the second half of last year. As I indicated already, the 500 million plus draw in the first half of this year, and a continued draw through the second half of this year. So the price will need to pull out incremental barrels, or either they need to get produced because there won't be the incremental barrels in inventory, or they will need to be explored. And whether that's in the US or in other places, incremental barrels will be needed to come to market in second half of this year.
When you look at that point, I mean, you have the strength in the demand recovery, economic growth is happening, but you still have massive stimulus coming and it's needed to support the economic outlook. You still have, and that's on the demand side. On the supply side, you still have the requirement of significant discipline on producers to keep supply curtailed. I mean, this remains a pretty fragile market, it seems.
Yeah, I think the demand. I think the demand recovery side continues to be robust, and so that is there. The economic indicators are all still positive, and the anticipation obviously is there that as we move through what potentially now is described as the third wave, and vaccinations take hold, and we get into spring, summer in the Northern Hemisphere, and we get continued economic support across the board, both in the OECD, in the US, that demand will maintain. And from the supply point of view, we have seen continued discipline from OPEC Plus, especially from the Saudis and their moves in January, and they will need to release the reins on that demand, that supply constraint. Sorry. So
would you expect Saudi to abandon that 1 million barrel a day unilateral cut in the second quarter?
I mean, I think what they've said and what they've done is continue to actively monitor the situation and what price level is acceptable to them or not acceptable to them to release that. It continues to be observed by all of us, but the market will need it. So my anticipation is that OPEC will continue to slowly ramp up production in order to satisfy the demand gap or the supply gap to meet the demand growth, which, as I said, by the end of this year, we fully expect to be back to 2019 levels.
You'd have to say one of the things that the Saudis in particular and OPEC plus, but the Saudi oil minister as the sort of leader of the group has done very well is sort of keep the market on its toes a bit, sort of these surprise moves. I mean, that 1 million barrel a day cut, obviously not really flagged. What had been a predictable roadmap that was laid out in April, this few hundred then, and then when this and then, they seem to have stepped away from that. And now each month or each meeting is sort of like a blank page and anything can come out of it. Do you think that's a strategy that works?
Well, I think it's a strategy that they've needed to implement, because I think none of us expected the extent of the downturn that occurred, and no one was 100% confident of the recovery. And I think that by having that active engagement and review, they've very much managed to stabilize and support the market, which, as we all know from a pricing point of view, they've needed to do. So I think it has largely been very successful.
Yeah, I think I would agree. Looking to the success of it, of course, from their point of view, is does it risk bringing in higher cost supply? And the first on the list that one would think of is shale oil recovery. US production down about 2 million barrels from a year ago. What's your outlook for shale oil recovery, particularly under the new Biden administration?
I think tempered. The obviously pricing will support. The production is down. The rig count is, I think, around 50%, 400 rigs versus 800 rigs, which was close to the peak. So rig count is well down. What we see the new administration doing is just tempering a otherwise very robust and flexible market, which is a U.S. Upstream market. It just temporizing that a little bit in terms of jumping back in and ramping up production. So we do see an increase in production in the U.S., but it's going to be at a much slower pace than it would have been, say, 2-3 years ago, responding purely to price indicators. And of course the financing available, the thought into how and when that capital is deployed will be a lot more considered, we believe. So it will come, but it will come more slowly.
Are you surprised, or how do you think about this now at the beginning of 2021, that there has been not more bankruptcies in the U.S. patch, or even more consolidation? There was news over the week that Exxon and Chevron were even looking at a potential merger of some sort, but that this downturn did not drive more consolidation or bankruptcies in the sector.
Well, I think that it's been fairly brutal. And I think that I don't have off the top of my head the numbers, but there's been a considerable amount of restructuring. There's been a considerable amount of capital flight. A lot of the easier capital that was dedicated to the sector has probably gone away. I think that everyone is being a lot more considered and measured in their approach. But I'd say that the consolidation waves have started, and they will continue to happen in both the in the various basins in the U.S. that exist. So you will continue to see consolidation, and a lot of costs will be sought to be driven out of the sector, especially by some of the smaller producers. So I think it's been again, I don't have the numbers off the top of my head. It's maybe something we can come back to in another discussion. But I think it's been fairly brutal.
I mean, one of the results of that brutality, if you want to use that word, has been a significant reduction in capex investment in new supply by most of the oil majors, without exception, on average 20 to 30%. I'm wondering, from your point of view, at what point does that become a consequence to the market, to new supply? We had the IEF, the International Energy Forum, come out with a report saying that they would need to boost investment by at least 25% over the next 3 to 5 years in order to avert a major severe supply crunch. I'm wondering what your own thoughts on the legacy of that capex reduction last year.
I think it's fair to say medium term, very supportive, because you have had this massive restructuring. The amount of money going into upstream oil has dramatically diminished. I mean, depending on time frame and quantum, but in the hundreds of billions of dollars has been taken away. You've seen a resurgence in everything that is green or alternative energy, and very much supported by us and by plenty of others, because in a world that continues to need energy, and where there is a huge populace that is not served by available energy today, we need to definitely promote alternative and sustainable energy. But the day-to-day demand for oil, which we see recovering to pre-2020 levels fairly quickly, will need to be sustained by oil as the only available stopgap, as we go through this path of sustainability, and the availability of incremental oil production is really quite limited, and that is medium term quite constructive oil price, because at
We
the end
are
of the
hearing
day,
people starting to mention the $100 number again.
yeah, as you know, it's very difficult to ever predict oil price, but
Yeah.
one way to cure demand is through price. So higher prices will curtail incremental demand, and again, in the transportation side, albeit avoiding jet, but in the rest of the distillate pool and in the lighter end pool, and petrochemical demand has been very robust.
Just in our last question, Chris, one of the big developments coming this year, next month, is the launch in the UAE and in Abu Dhabi of the ICE Abu Dhabi exchange, and the launch of the Murban futures contract, which will be physically settled in Fujairah. A sort of two-part question. How significant will this be, do you think, for the market to have a new contract on Murban? And secondly, what does it mean for Fujairah? What could Fujairah do to take advantage of this new development?
There's existing infrastructure in Fujairah that is well suited to facilitate the delivery of physical crude. I think in addition to that, which is infrastructure today that has been constructed and is being used by ADNOC directly, but in a more fungible market that should be and would be promoted by the development of the futures contract, what one would anticipate that there's flexibility around the delivery mechanisms, not only to the existing SBMs there, but there's an existing very sophisticated VLCC jetty there, and there's a very interconnected matrix manifold system in Fujairah today, linking multiple terminals up to the ADNOC infrastructure. So assuming connectivity would exist between the rest of the Fujairah infrastructure and the current ADNOC infrastructure, I think it would give a lot of flexibility to the delivery mechanisms around that contract, which, depending on market structure and market dynamics, may allow a lot more fungible movement of the crude, which ultimately I think would be a very good thing for the industry and for Fujairah, because it brings another arrow into the Fujairah quiver, for flexibility and for storage, blending. We're fortunate enough to have a refinery there. There's some other small refineries in Fujairah too. It provides a huge amount of flexibility to the Fujairah platform. So I would say it's very constructive for Fujairah.
And speaking of the crude side, a lot of the Fujairah history has been about storage for products, the availability of increased storage for crude. Does that need to increase, or is that the opportunity, the future for Fujairah in crude oil storage rather than more products?
I think it definitely there is a relatively small amount in the mix of the Fujairah storage equation. There is a relatively small amount of commercial storage available for crude, but I think it would definitely give the flexibility for tanks that are otherwise storing products to be used for crude and/or provide incremental crude storage. So I think, yes, I think it does add another layer to the dynamics of the Fujairah market.
And just to finish off with the terrible question of where is oil price going over 2021, we did a survey on our daily webinar today, which was like, what could be the highest price? And 65, 70, or 75, even if just for 5 minutes. And of course, the answers were spread across all three quite evenly. If you were on the call this morning, Chris, which one of the buttons would you have pressed? I mean, do you think there is a ceiling that can be reached this year that is beyond where we're at?
I think definitely the market has all the right elements in it to definitely go higher, because assuming the current trajectories, we're going to need more oil to come to market. So that is going to have to force the oil price higher, and then eventually it will get to a level where it starts to curtail demand. But as long as we maintain current draws, and the supply demand balances are where they are, we need incremental oil to come to market, which should happen with higher prices.
Yes, it certainly should. Chris Bake, Vitol, thank you so much for being on Halftime Talk this week. Great to have your insights at the start of another pretty exciting year. I'm sure it will be for everybody. And be safe in London. Enjoy the snow. Make a snowman. And we look forward to seeing you in Dubai and Fujairah sometime soon.
I hope so. I very much hope so. Thanks, Sean. Take care.